Good morning, everyone. It's just now 10 o'clock, so I'm going to give everyone a moment to come in. I do appreciate everyone taking some time on a weekday morning. I know especially those of you who work in legislative offices that this is a very busy time of year. Whether you're a member or whether you're a staffer, we certainly appreciate everything that you do to keep legislative sessions on track. And we know that this is a time commitment for you, so thank you. Also for anyone you know who might not have the opportunity to be on this today, because obviously there are these time constraints. This will be available online later. We will have a video copy of it. So we're just going to give it another minute or two, and then we will get started. Thanks. Well, thank you for joining us today. I'm Jared Walzak. I'm Vice President of State Projects at the Tax Foundation, and this is a Talking Tax event on state tax considerations in a high inflation environment. It's obviously not news to anyone that we've had significant inflation over the last couple of years. The good news is that that is tapering off. In fact, we've even seen in recent months some declines, but nonetheless, we still know where things stand. We have 14.6% higher prices at the end of the last calendar year than we did 2 years prior, and that's not changing anytime soon. So lawmakers across the country are trying to respond to this with any tools they have available to them. And we all know that inflation is largely a monetary phenomenon, meaning that there aren't actually that many tools in a state legislator's toolkit to respond to inflation. There's palliative measures. There's ways to try to ease the burden for individuals and businesses in the state, not necessarily tackling inflation, but trying to address some of its more pernicious effects. There's also the question of, can you actually do something to reduce inflation at the state level? What might those be? And then how do you avoid contributing to some of the underlying causes of inflation? Understandably, tax has been at the center of many of these conversations, and that's not the only way that state lawmakers are responding to inflationary impacts. There are a lot of spending programs that are about providing relief for individuals who may be hardest hit by some of these higher prices. But we are a tax organization, so we wanted to spend some time today talking about what is happening and what lawmakers have been considering as tax responses in this high inflation environment. Because we've seen the gamut. We've seen tax rebates, we've seen tax holidays, we've seen questions about how do you properly adjust for inflation within the tax code? Questions of how do you handle, encourage investment in a high inflation environment? Questions of what do you do about property taxes at a time when property values are soaring? And we want to tackle all of these today and also spend some time answering any questions that you may have. I'm joined by my colleague, Catherine Lawhead. She is a senior policy analyst here at the Tax Foundation. And I'm going to kick it off by turning it over to her to talk a little about one of the responses that we have seen in many states, which is tax rebates. And at any time during this discussion, you should be able to see a Q&A box. Feel free to put something in there. We'll probably take most of those towards the end, but as you have questions, please go ahead and use the Q&A box.
Well, thank you, Jared, and thank you all so much for joining us today. As Jared mentioned, we're going to go through a few of the suboptimal policy solutions that some lawmakers have considered as they have been striving to address the inflation that we're all experiencing. And two of the most common tax relief measures we've seen states take over the past couple of years have been to offer income tax rebates and various tax holidays. And those tax holidays include gas tax holidays and sales tax holidays. Since 2021, we've seen approximately 19 states offer individual income tax rebates, where taxpayers receive a direct deposit or a check in the mail to reimburse them for a certain amount of income taxes that have already been paid. And in that same time, we've seen 8 states that have offered some sort of gas tax holiday. Now, in some of these states, like Connecticut and Florida, the state did not collect the state excise tax on gas at all for a specified period of time. And in other states like Illinois, the gas tax continued to be collected, but the state simply postponed the date on which the automatic inflation adjustment kicked in. So in addition to those things, we also saw sales tax holidays in a number of states. In both 2021 and 2022, we saw 17 states offer sales tax holidays. And most of those states offer these holidays year after year, where certain goods are excluded from the sales tax for a certain specified period of time. But in the past couple of years, we've seen a couple more states offer those than normal, and we've also seen them expand the amount of time the holidays were in place for, or expand the basket of goods and services that were exempt from the tax during that period. Now, there's no doubt that these tax relief measures have been politically popular, because taxpayers, of course, tend to like income tax rebates. Who doesn't like receiving a direct deposit that you weren't expecting? And politicians on both sides of the aisle have shown that they wanted to respond quickly to their taxpayers' concerns about inflation when inflation was at its highest and when it was at the forefront of taxpayers' minds. And frankly, it is politically difficult for legislators to vote against a bill that would provide quick tax relief to their constituents. And when all the states around them are doing things like this, that can add to the pressure that politicians and lawmakers face when thinking about these types of tax relief measures. But just because something is good politics doesn't make it good policy. And so this is one of the suboptimal policy solutions, and there are a few different reasons for that. One of the reasons rebate checks and tax holidays are suboptimal is because they provide only temporary relief. They don't provide any sort of long-term tax relief, and they don't improve a state's tax structure in any meaningful way. Another reason they're less than ideal is because they are a form of retroactive policy. And what I mean by that is that tax relief that is being provided with a rebate check is based on economic activity that has already taken place. It's based on hours that have already been worked and income that has already been earned. So on the other hand, more pro-growth structurally sound reforms like rate reductions and other structural changes are a form of prospective policy. So they can change and influence behavior by changing future incentive structures. And prospective policies are ideal because they can promote economic growth in a way that retroactive policies don't. And then a third reason that these tax relief measures are less than ideal is because rebate checks and tax holidays are themselves inflationary policies that make inflation worse, not better. And while any one state that's thinking about adopting these measures might not think it's a big deal if they do it, when many states are doing these things at the same time, that's exacerbating inflation. It's not combating it. And the United States economy as a whole would really be better off if more states resisted this temptation to offer rebates and tax holidays and instead channeled those efforts into longer-term pro-growth structurally sound reforms, as well as also shoring up their rainy day funds to make sure that every state is well prepared to weather the next recession. So now I'll hand it over to Jared to talk about sales tax exemptions for groceries, which are another form of less than ideal tax relief that has been adopted.
Thanks, Catherine. And it's if you've been to a grocery store at any point in the last couple of years, you've witnessed firsthand just how expensive it has been to put food on the table. And no, your eyes are not deceiving you. The prices are up a lot more than CPI would indicate, because groceries have been one of the highest growth areas. Just this past year, for instance, we know that through November, inflation overall was up 7.1%. Groceries are up 12%, and the previous year, I believe it was even more stark. So grocery prices are up over 25% over the last 2 years. And for certain households, it's going to be even more extreme than that, not just because of regional variations, but also if you imagine that perhaps lower income households are more likely to consume maybe prepared and processed foods. Those have in some cases been subject to even higher price increases than, say, some of the other ingredients you might find in a grocery store. So this is significant. And it's no wonder why policymakers have wanted to respond to this by saying, well, maybe we can reduce the cost of groceries by taking it out of the sales tax base. And it really goes to a longer standing question of should they be there in the first place? Is this regressive? Because the sales tax itself can be regressive for two reasons. It can be regressive in the sense that of what's in the base, that it's taxing things that are more consumed by lower income individuals and not taxing some of those consumed by higher income individuals, particularly the exclusion of many personal services from the sales tax, which tend to be consumed by higher income individuals. Can also be regressive just structurally from the fact that since it is on consumption, lower income individuals consume a much broader share of their income than higher income individuals who save. Now, over a lifetime or over lifetimes, consumption and income tend to largely even out. So if you do life cycle analysis, some of that disappears. But in most given years, lower income individuals are certainly consuming a much higher share of their income. And a lot of that is going to things like groceries. So there's always been this question, can we help? Not only as an inflation response, but to make the tax code a little more progressive to help those in need, should we take groceries out of the sales tax base? It is not really all it's cracked up to be. We've run some numbers. There are a couple scenarios in front of you that I can explain, but basically, here's the headline. If you have a certain amount of revenue that you can devote to reducing sales tax collections, and you have a choice of whether you want to reduce the rate on everything for everyone, or if you want to carve groceries out of the base, you're actually helping the lowest income households more by reducing the rate on everything than you are carving groceries out of the base. And I know that's counterintuitive, but the reality is that because in every state, SNAP and WIC-based purchases are exempt from the sales tax, even though obviously that does not cover all of the grocery purchases for pretty much anyone, it covers a significant share of them for lower income households, while at the same time, they are paying a lot of sales tax on everything else they're purchasing. And they are better off if you reduce sales tax on everything they're purchasing that has it, than if you exempt groceries, which does exempt some tax groceries they're purchasing, but also exempts a lot of things that were already, frankly, exempted for them. So we ran some numbers looking at three different scenarios where first, you take groceries out of, you take groceries out of the base, or you add a credit. We did a couple of different things. We have a paper that we can link to that shows, but what we basically found is that if you simply reduce the rate in a revenue neutral way compared to what you'd spend getting groceries out of the base, you benefit the lowest income households. And if you use a portion of that to provide some sort of grocery rebate or credit, the refundable credit, like many states do, that you can even accelerate that. You can make it a much more progressive policy that has the added advantage of being more economically efficient, because groceries are a pretty stable and important part of the sales tax base. Most states have unfortunately carved it out for the best of reasons, but it's made their sales tax collections more volatile. It's pushed them into relying more on income taxes and other taxes that can be more economically harmful, because consumption taxes do have the advantage of being actually fairly economically efficient forms of taxation. So this has been a net loss for them. If you're weighing consumption versus income taxes, it's one thing to say, okay, consumption taxes are more economically efficient, but we're concerned about the distributional effects, so we're going to balance this in some way. It's another thing to say, this isn't even helping on the distributional effects. It sounds like it will, but it doesn't. And yet we're carving out that base. And that's what has happened in a lot of states. So we've urged states that still do have groceries in the base to some degree, there's 13 of them, not to see this as a good inflation response. There's far better ways to provide relief, whether you want to target it or whether you want to provide broad-based relief, than to further erode an already rapidly eroding sales tax base.
Well, so now that we've mentioned some of the less effective tax relief measures like tax rebates, tax holidays, and sales tax exemptions for groceries, we'd like to offer some more effective tax relief alternatives that provide long-term rather than just temporary relief, and that improve states' tax structures in the process. So the first reform solution we want to recommend today is for states to index their individual income tax brackets, standard deductions, and personal exemptions to inflation. And by this, I mean that if your state has a graduated rate individual income tax, ideally the income levels at which higher rates kick in should be adjusted annually for inflation. Similarly, if your state offers a standard deduction or a personal exemption, the amount of that deduction or exemption should also be adjusted annually for inflation. Now, failure to adjust income tax brackets results in what's known as bracket creep, where increases in a taxpayer's nominal income or the face value of their income can result in them being pushed into higher tax brackets, even if the real buying power of that income has stayed the same or even decreased. And additionally, failure to inflation index income tax brackets exposes a greater share of each taxpayer's income to higher rates, with those higher rates being rates that were not originally intended for those relatively lower levels of income. And failure to adjust standard deductions and personal exemptions results in the erosion of the real value of those benefits over time. So to illustrate specifically how bracket creep plays out, let's take a hypothetical tax rate schedule in which a 3% tax rate is levied on the first $10,000 in income, and then the marginal tax rate increases by 1 percentage point for each additional $10,000 in income, and it caps out at a rate of 7% on all income exceeding $40,000. Now, imagine these rates have been in place for 50 years. So they were enacted in 1969. They stayed the same till 2019. So they've been in place for 50 years. And say you have a hypothetical taxpayer who's been working all this time and has received cost of living adjustments, but no other pay raises during that time. So in 2019, this taxpayer makes $50,000. But back in 1969, when he first started out, he was making only just over $7,000 in annual income. So in 1969, with an income of less than $10,000, all of this taxpayer's income was subject to that 3% rate. But by 1989, with an income of just over $24,000, this taxpayer's income was spread out across 3 different brackets, with rates ranging from 3 to 5%. And then by 2009, with a salary of nearly $42,000, this taxpayer had income spread out across all 5 of those income tax brackets, even though in real terms, the purchasing power of his income hadn't increased at all. So in 1969, this taxpayer's top marginal rate was 3% because all of his income fell within the first bracket. But by 2019, the taxpayer's top marginal rate is 7% because his income now exceeds that $40,000 threshold. So if you calculate the taxpayer's effective tax rate by taking his liability as a share of his income, that yields an effective tax rate of 3% back in 1969, but that effective rate increases to 5% in 2019. And now I know that's a bit of an extreme example, but it shows how failure to inflation index income tax brackets can result in taxpayers being pushed into higher tax rates, and it can result in their effective tax rate increasing even if their real buying power hasn't increased at all. And in real life, of course, the effects are even worse because most people's wages and salaries grow quite a bit as they age and gain more work experience. So now for a real life example of how failure to inflation index the standard deduction plays out, Kansas is one of those states that has a single filer standard deduction that stayed frozen at $3,000 for over 2 decades. So it didn't change at all between 1988 when it was first enacted and 2020. Now in 2021, a law was finally enacted that increased that standard deduction to $3,500, but that still isn't enough to account for the inflation that occurred during that time, because $3,000 in 1988 is the equivalent of over $7,400 today. So ideally, that deduction should have been increased a little bit each year to keep up with inflation, but because the standard deduction isn't indexed, that deduction has eroded to less than half its former value. And I'll note that Kansas is also one of the states that doesn't index its brackets or personal exemption either. So that compounds the problem and compounds the effects that taxpayers are experiencing. So the point of all these examples is that when these major income tax provisions aren't adjusted for inflation, that's a type of unlegislated tax increase where the government is bringing in more and more revenue every year simply as a result of inaction rather than as a result of proactive policy decisions to increase tax rates. And when you think about how much of the inflation we're experiencing now was either caused or exacerbated by bad policy decisions that were made at the federal level, it really doesn't seem right that state governments should automatically get to pocket more of that money as a result of poor policy decisions that are made by the federal government. And of course, these unlegislated tax increases are occurring at a time when taxpayers can least afford to pay more. So inflation indexing is an especially timely solution for states to consider right now, because while many employers have adjusted their employees' wages by providing raises or cost of living adjustments, across the board, real increases in wages have not quite kept up with real increases in prices. So how many states are in good standing when it comes to inflation indexing? Well, as of January 1st, 2023, of the 30 states plus DC that have a graduated rate income tax bracket, only 14 of those states fully index their bracket levels to inflation. So about half of the states are doing the right thing on brackets. And then of the 44 states in DC that have a standard deduction, 32 states in DC index that for inflation. But of the 44 states in DC that have a personal exemption, only 25 states in DC are indexing it for inflation. And so you can see there a list of states on the screen that fail to fully index either their bracket, standard deduction, personal exemption, or all three. So they have some room for improvement there. And to find out specifically what your state has room for improvement in and which of these three areas it's lacking in, our state business tax climate index has a handy table. It's table 14 on page 66, and that has a list of which states do what. So if your state isn't on the list of states that is doing the right thing across the board, making inflation adjustments could be a really timely and pro-growth reform to consider. And so some of you may also be wondering why we're specifically targeting the income tax as the place to make these inflation adjustments. And one of the key reasons for that is that it's possible to make these automatic adjustments to the income tax in a way that's not quite as feasible with other types of taxes. So when taxes are levied on an ad valorem basis or as a percentage of the value of whatever is being taxed, those taxes by default are going to generate more revenue when inflation is high than they will when it's not. So that applies to income taxes, sales taxes, property taxes, and others. So say, for an example, an employer gives their employees a 9% cost of living adjustment to account for inflation. If that's the case, an employee who made $50,000 will now make $54,500. But say that employee lives in a state where there's a flat 5% rate on all income. So even with a cost of living adjustment, that employee will pay $225 more in taxes after they get the cost of a living adjustment than they did previously. Now, similarly, under the sales tax, if the price of a pair of tennis shoes has risen from $100 to $110 due to inflation, a 6% sales tax is going to bring in 60 cents more from the sale of that pair of shoes than was brought in when they cost only $100. And that same thing applies to property taxes, which Jared will get into in a minute. But if you have a property tax system where no limits are in place to prevent inflation-related revenue increases, the government will end up collecting more revenue when assessed values rise, even if the cost of local government services haven't increased by a commensurate amount. So given that ad valorem taxes of various types bring in more revenue during periods of high inflation, it is especially important to make sure that income tax provisions or any tax provisions that can be adjusted are adjusted to help prevent these unlegislated tax increases. So with that, I'll turn things back over to Jared to talk about property tax limitations.
Thanks, Catherine. And I wanted to add to that on the income tax piece that with income taxes, it's not just that there's more income and therefore it's being subject to tax, but again, it's this bracket creep that you are taxing it at rates that you did not intend. And that is different than with a sales tax or the property tax or with any other tax where inflation is increasing collections, but the base that's being taxed has changed as well. But with property taxes, there is a clear issue, and homeowners, I think, are somewhat reasonably upset that nationwide, it's going to vary a lot from state to state, but in most states, you've seen appreciation of assessed values of between 25 and 40% over the last couple of years. And frankly, that's a lot. And it's good news, I suppose, if you were selling at the peak there. It's not necessarily good news if you're a taxpayer who hopes to have this land for a long time, because your property taxes are going up commensurately, and you are not receiving 40% better or greater amount of services from your local government. And by the way, local government costs, while they've risen because of inflation, have not risen by anywhere near the amount that property taxes have risen. So again, there's understandably some consternation, and property taxes tend to be one of the most transparent taxes. People know what they pay in property taxes, and therefore I think people get madder about property tax than probably just about any other tax they pay. Economists tend to like property taxes because they're relatively efficient. I mean, you can't really move your land, so you're not going to make as many economic decisions based on property taxes as you would income taxes on that, marginal return to labor or capital. People who pay taxes don't always share the view of economists. They don't like them very much, and they may not change their economic decision making, but they certainly do know how to pick up a phone and call their lawmaker and say, why are my taxes so high? So understandably, there's been a lot of sensitivity to this. Many states are looking at providing some sort of property tax relief. This is difficult fundamentally because it's state lawmakers trying to provide relief for a tax that is almost always paid at the local level, local decision making. So there's only a few tools available to lawmakers. They can change assessment ratios, which basically just reduces everyone's tax rate across the state unless local governments re-raise the rates. That's not very popular unless you have a backfill. And even then, I would say it's not very popular with local officials who understandably have some real concerns about that. You can also limit the rate of growth, and that tends to be much more viable. And I think sometimes very much the right call, because it may make sense that there be more property tax collections now than 2 years ago. It probably doesn't make sense that there's 40% more. That's probably too much. Having some sort of limitation regime in place to keep that growth in collections in check is prudent, it's responsible, it's fair to taxpayers. The challenge is getting it right. Many states are looking at assessment limitations, and assessment limits basically limit the growth in assessed value and therefore of taxation for any individual parcel of property. They vary in when or if that resets. Sometimes it resets upon sale. Sometimes it only resets upon major improvements. Sometimes it basically never resets, but usually it's going to reset under some circumstances. What this does is it locks people in. It basically says, well, you know what? If this is your land, you're going to stick with it. You don't want to upgrade to something larger for your family. You don't want to downsize when you're empty nesters. You don't want to build a major improvement, do significant renovations, sell it for some higher use and move somewhere with the proceeds, because all of these things, even if they make good economic sense otherwise, are going to reset your property tax. It's going to put you into a situation of paying way more in property taxes because you had been shielded from increases all this time, and then suddenly they all come rushing back in, or you go to a different property that has them at closer to market rates. This also, of course, creates situations where people who live across the street from each other in functionally identical houses could be paying radically different amounts in property tax to the same local government. There's just a fairness issue. And this fairness issue gets exacerbated when you think about the demographics of who will be impacted by that. You will be, among other things, shifting more of the cost of property taxation to younger and lower income householders. Those who are buying new homes or are buying for the first time. If you think about the racial demographics too, it's not one-to-one, but you will find often that, of course, you have homes that have been lived in for a very long time that may have white homeowners, and racial minorities often are newer homeowners and may be paying higher rates. In fact, some of the first significant reform you have on your screen, the effects of some property tax limitations in Connecticut, Massachusetts, and New York. And Massachusetts adopted some pretty good property tax limitations years ago after a very old system was thrown out by the courts because it functionally left a lot of Boston Brahmins paying next to nothing, while low-income communities, often communities of color, were paying market rates. And it was just radically different and very inequitable. So there are right and wrong ways to do this. The right way, we would think, is what's called a levy limit. You're limiting the overall amount of collections increase, and you're rolling back everyone's millages proportionally. So if your property became significantly more valuable while another person's property in the same area lost value, your property taxes should rise compared to theirs, but they should all rise within an overall limit that's limiting the growth of overall tax collections in a community to some reasonable amount, which probably isn't 40% over 2 years. Now, new construction should be outside the cap. You should have reasonable amount of growth where necessary, and you should have overrides so that if the community says, yes, we actually do think we need to raise property taxes, increase collections substantially for some local purpose, we can do that. And the evidence is taxpayers at the local level, they really feel the local services, and when local governments make the case to them, it often it flies. But you need to make the case. You can't just say, well, property values are up 40% increase in your property taxes. So levy limits can be good policy, and several states are pursuing those right now, but a lot are looking at assessment limits. And that was where property tax limitation started. That was California Prop 13, but it's been a lot of states, red and blue. It makes a mess of property tax systems. Every year there's further adjustments to try to make it work, and you're distorting the market. You're creating an unfair system. You're penalizing newer, younger, and often lower income homeowners. It's not a system designed for the long term. So levy limits, not assessment limits. There's also rate limits. They're just not very effective. It's pretty easy for a local government to work around them. But it does make sense to think about how can you constrain the growth of property taxes when it has nothing to do with the conditions on the ground, and it's just because property values have risen so markedly. And then finally, one other thing we want to talk about, there's always a question like, well, okay, all of these things are maybe responses to inflation. Is there anything that governments can do at the state level that actually addresses inflation? And the answer is not a whole lot. That's not really the role of state governments. However, one issue we definitely have that we've had since the start of the pandemic is a desperate need for many businesses to retool. A lot of us changed how and where we work, how we consume. Consumption patterns just changed quite a bit during the pandemic. Some of them have shifted back, some of them haven't. And we've seen the difficulties of businesses responding to this changing demand where they need to retool their facilities, maybe because of various supply chain bottlenecks that continue across the world. They need to bring more things on shore, or they need to change their supply chains in some way. This all requires investment. And if these changes are for the long term, they're going to make these investments. But an added difficulty for them right now is that inflation can erode away some of the tax element here. So in traditionally with the corporate income tax, when you have costs as a business, you're able to deduct those because it's supposed to be on net income. But machinery, equipment, and other expenses like that, they were essentially amortized over a period of years. They were depreciated, and you essentially recovered the cost over a period of years rather than taking it in the first year. For decades at the federal level, there have been improvements in that policy to say, this is actually a cost that you are incurring immediately. You should be able to expense it. And with the Tax Cuts and Jobs Act, immediate full expensing of at least certain classes of machinery and equipment purchases were allowed to be expensed in the first year. And that was great policy. And a lot of states, 17 of them initially, and growing, conformed to that and provided at the state level as well. Because of the way that the TCJA was adopted through reconciliation, this was limited. It only applied for 5 years, and then it starts to phase down. And it doesn't just phase back to where it used to be pre-TCJA. It disappears if we don't have extenders and goes to just the old depreciation regime, the maker's system, without any sort of bonus depreciation or accelerated cost recovery. This is bad at any time. It's really bad in an era of high inflation, because what it means essentially is, yes, eventually you will be able to recover, all of the cost of your equipment in terms of the your tax base over a period of years, 10, 20, 30 years. Most of these tend to be 5, 10, 15. They're different depreciation schedules for different things. Over time, though, these assets, of course, they're long gone potentially, or they're nearing the end of their usable life. You are paying the inflation costs. So you can see an example of that, $100 machinery investment, you get the allowable deduction, and there's this delta, the amount that's disallowed. And over the life of this product, over its depreciation period, you're losing something due to the time value of money and due to inflation. So especially right now when inflation costs are very high, this is a significant concern. I ran some examples recently that you can see online. We'll send you a couple of links to this, but you can easily find situations where these are significant costs. Let's imagine a company purchased maybe $1 million equipment purchase in July 2019. By June 2022, 2 years later, the company would have generated $500,000 worth of deductions. Simplifying a little, you can't split 2022 like that in practice, but over that period, there's a 15.5% inflation. So even though they deduct $500,000, the deduction is just worth $432,993 in present value. It erodes by $67,000 and change. If you have a, say, 6% state corporate income tax rate, you've paid $4,000 more, a little more than that, in tax in real costs than you would have if you were able to deduct immediately. It's even worse because the federal government at higher rates is also not providing you this. Now, that's just one hypothetical $500,000 in deductions. Nationwide, U.S. equipment expenditures totaled $1.15 trillion in 2019, and it's growing. This is a lot of money that is now being eroded to some degree due to inflation. Now, states can't force the federal government to make the right policy choice here. Hopefully, this will get done eventually. But states can go it alone. States can say, we are going to allow full expensing. We're going to make it more attractive for businesses to invest and grow their operations here. We're not going to penalize them for investing, and we're certainly not going to let inflation erode away the value of that investment. And so we are encouraging states to look very seriously at adopting permanently what the federal government did for a handful of years, which is the full immediate expensing of machinery and equipment purchases in their first year. That is something that not only addresses an inflation problem for businesses, but actually helps get out ahead of some inflation, because it lets businesses do the reinvestment that will allow them to address the supply chain crisis that, even though it's not the same as it was a year ago, is still a significant issue driving up prices. So drive down prices, increase investment, limit the degree to which inflation is eroding business returns and discouraging business investment. So those are some solutions that we think are appropriate for states to consider on tax policy. Now, some of these, I know there's legislation that had been pre-filed last year and they'll be considered this year. Some of these, may still be introduced depending on when introduction deadlines are in different states, and some of them may become part of budgets. There are a variety of different approaches, but we think these are all worthy of consideration. Certainly for any lawmakers or legislative staff on the call who want to talk about this offline at any point, we are available. Our contact information is on the screen. Give us a call, shoot us an email if we can help. We want to. And with that, I think we're going to use the few minutes we have left to go to a few questions. And I do want to say that all of this information and the slides in the video will be sent out soon to the email list, so everyone should receive a copy of that. Got a question from Scott Peterson on how direct is the correlation of inflation with individual income? And the answer is it's pretty close over the years. If you go back like 50, 60 years, you'll see that real income has increased. So there's been an increase above inflation, but by a very modest amount. Wages, this has been one of the problems for years, and we did see wages start to tick up after the TCJA, but nonetheless, overall, for the most part, a lot of salary increases, a lot of individual income increase has been inflation linked. So if you have no inflation indexing in real terms, you're paying a lot more in taxes than you used to. Another question from Alan: what is the result of the Trump tax changes? Did tax income go up or down? It seemed to help the lower and middle class taxpayers, contrary to what some believed. So a number of things happened. Firstly, revenues were very robust. I think some of that was because of the tax changes, which did encourage some additional investment, onshoring of some activity. It changed some of the incentives. That's all good news. I think also it happened at a good time where revenues were going to rise. So it really did help that revenues were very solid during that time. There were tax cuts for just about everyone. I think there were some impressions that the tax relief was only for certain classes of individuals, and that wasn't really true. Some of the simplifications on the individual income tax in particular did provide relief for a lot of lower and middle income families, and to the degree that there is a creation of additional economic activity, that's benefiting all. One thing, though, is that because the tax changes broadened the tax base but lowered rates, states had that broader base usually flow into their own tax codes. And if they didn't lower their own rates, that actually meant that you had higher tax collections in states. Now, some of them did cut rates. Most of them didn't cut them to a revenue neutral standpoint. That's one of the reasons why revenue has been so high in states. Now, there's a lot of reasons in the last couple of years why revenue has been soaring, but one of the reasons why we have a higher baseline now than before is because we do simply have a broader tax base in the states than we did a few years ago. Catherine, Adam has a question. Nationwide tax rebates have a detrimental impact on inflation. Are there studies that show regional inflation when states enact tax rebates individually, or what are your thoughts on the inflation impact?
Yeah, I haven't looked at those studies, but it does seem pretty clear that when states enact these rebates, and when many states do this at the same time, that is exacerbating inflation, and that's not helping solve their problem in any meaningful way. It's channeling more money into the economy at a time where there's already too many dollars falling to few goods and services. So it's definitely exacerbating the problem.
And we have a follow-up question there about, we talk about inflation indexing, but would a single rate income tax with an index standard deduction be the most fair and uniform approach?
That's definitely going to be a more neutral approach than having a graduated rate structure. There have been a lot of states that have moved toward flat rate structures in the past couple of years alone. And it's really the most neutral and pro-growth policy, because graduated rate income tax structures are penalizing additional labor and business investment on the margin. They're penalizing productivity, whereas a flat rate structure would remove that penalty for productivity, and it would help promote upward mobility at the same time. And one of the ways to mitigate the impact on lower income individuals, or to make sure that everyone gets a net tax cut, would be to flatten the rate while also increasing the standard deduction at the same time. That's definitely a good policy reform to consider.
And we have a member from Kentucky, Ken Fleming, who just notes that he has a bill conforming to Section 179, which is the small business expensing in Kentucky, which is great. States should be looking at 179 conformity, and they should be looking at Section 168K, sort of TCJA max conformity, where you're providing that full expensing. So it is wonderful that a number of states, Kentucky, New Hampshire, a few others come to mind, are doing that, and that Oklahoma last year did the right thing on adopting permanent full expensing. We certainly appreciate a lot of those efforts. And then we have a question from Vance. Given the ongoing state flat tax revolution and substantial budget surpluses in many states, how would you recommend states improve their tax systems to make them more competitive without running into the Kansas problem? And I think all of you are probably familiar with Kansas over a decade ago now, where substantial tax cuts that Governor Brownback promised would lead to such significant revenue increases that they would be able to fund government at a higher level after cutting $1 billion in taxes. That did not materialize, and they ultimately had to reverse those tax cuts at significant cost to the state and a lot of its investments. So there's a few things here. State revenue baselines are significantly higher than they were 5 years ago. So states are in a position to cut rates and still have a growth trajectory on overall revenues. We've also just seen robust economic growth in recent years, and we've seen some of the responses to some of the investment incentives structures in the TCJA and in some state tax choices. We also know it's just a very highly competitive tax environment right now because of the additional mobility that individuals and businesses have, that states really are competing on low rates. So there's a good opportunity, and it's a good time to reduce rates and to try to create a more competitive and pro-growth environment through the tax code. Now, there's right ways and wrong ways to do this. I have definitely seen states where they get so fixated on what I think of as a subordinate goal that they forget the ultimate goal. They might say, we want to repeal the individual income tax because we see a lot of states without income taxes that are doing great. And they're kind of right. I mean, there's a lot of good reasons to reduce reliance on your income tax or even to not have one, but they get so focused on that goal that they forget that the real goal is a broadly economically competitive environment. And they say, we'll replace it with anything. It doesn't matter what the tax is, we'll replace it with anything. Or we won't replace it and we won't worry about the deficits and we won't have a plan for cutting spending. We'll just sort of hope it all works out. And that's not how it works. There are genuine returns on lower taxes. You see economic growth associated with this. There's very robust literature showing that you get this dynamic feedback effect. But you shouldn't assume it's a dollar for dollar replacement. That's what Kansas basically did. They wanted to cut $1 billion in taxes. They were initially going to cut about $900 million in spending. They couldn't agree on those cuts, so they adopted the $1 billion tax cut with no reduction in spending. And this was not a period of upward trajectory and growth. This was pretty flatline period. And they just said, well, it'll all work out in the end. It did not. Don't do that. And we have actually testified in a couple of states in last year saying, this might be too far, too fast. This isn't going to work the way you think it is. The flip side of this is that 43 states have provided significant tax relief over the last 2 years. 28 states have cut the rate of a major tax. I think 21 of them have cut the individual income tax rate. 13 with a significant overlap have cut corporate income tax rates. There's a lot of room to do that right now. There's also a lot of room, even for states where maybe they don't have the sustained revenues to make a cut, to make structural reforms, to make their tax codes more favorable to remote work and to businesses that want to allow that, to improve their expensing regimes, to adopt inflation indexing. There's a lot of structural reforms that are more modest in their revenue impact, but can make a really big difference. Let's see, I think that we are pressed for time, so I'm going to wrap this up in just a minute. But I do have a question here on thoughts on expansion, reduction, or elimination of credits, deductions, or exemptions. And I'll close with that question. As with everything else, credits, deductions, and exemptions have to be judged on their own merits. They vary. But generally speaking, economic development incentives are less productive and less neutral than simply having lower rates and a better system for all comers. We see this in states that maybe at one point created incentives for the economy they had or thought they wanted, and time passed them by. North Carolina is a great example of this. Decades ago, they had pretty high tax rates, not very high tax collections, but essentially what they were doing is they were carving out the agricultural and textile industries, and everyone else got a bad deal. And they had the research triangle, but all the businesses that were created and spun out of that, they left because it wasn't a good tax climate for them. And North Carolina, instead of saying, okay, I guess we're not textiles anymore, let's be tech, they said, why don't we let the market decide what we'll be? Why don't we create low neutral taxes with a broad base and let the rest work itself out, so we don't have this other system ossifying around our choices? And that's the right call. So reducing reliance on incentives, especially business incentives, I think is the right call. It also creates a lot more stability in your revenues, a lot more predictability there, which is important. And you're not, not picking winners and losers the way that states often do. But even within incentives, a broad-based investment incentive is far better than a really targeted one that changes business behavior. So I recognize that states aren't getting out of this business, but there's at least ways to reform it, reduce reliance on it. Broad bases, low rates. It's the mantra of everyone in tax and public finance, but it's the mantra for a reason. I know that we did not get to everyone's questions. If we missed your question, our email addresses are on the screen. Please shoot us a follow-up email, give us a call. We would love to answer those. We appreciate everyone being on this Talking Tax webinar this morning. We know that this is a busy time, so we're grateful that you made time for us. Our website, taxfoundation.org, has many other resources for state lawmakers and legislative staff and those in the policy community, looking at a wide range of tax issues, including things that are popping up right now, like the wealth tax proposals in 8 states. So take a look at our research. And again, feel free to reach out if we can ever be of assistance to any of you. Thank you so much for your time.